Hello everyone, welcome to Online G Academy. So in this lesson, we're going to focus on introduction to Forex. So this week, which is week 1, we're going to be focusing on Forex basics, which is like introduction to the Forex market and everything you need to know about the Forex market. At least essential information, not just everything. Okay, so here are the learning objectives for this lesson. So we are going to talk about Forex, like what is Forex, tips for a successful start, and we're going to talk about currency pairs. We're also going to talk about bid ask spread. What is bid, what is ask, and what is spread. And we're going to also talk about the lot size. Okay, so let's get started. So what is Forex? You have done this before. You've gone maybe to a foreign country, and maybe you have gone to, let's say for example, you're from South Africa or United States. Okay, let me just use South Africa for example, right? So let's say you're from SA and you go to a different country, which is USA, for example, right? So in this case, in USA, they use the United States dollar, and from SA, you come with South African rand, which is, let's say, ZAR. That's what it's called, right? So you go to USA. So for you to buy goods in USA, you need to convert this South African rand into the US dollar. So what you do is you go to a money exchanger or to a bank, then you can actually buy the United States dollar. So what you're actually doing in this case is you are buying the US dollar and you are selling the South African rand to this person, to the person that you're buying from. All right. So Forex, it actually refers to foreign exchange markets, right, where currencies are traded. So in simple terms, we can say Forex is simply buying and selling of currencies. So in Forex, we actually buy and sell currency pairs, and we make profit either way, right? So Forex trading is actually a profession with relatively unlimited profit opportunities, right? But there's a catch to it. So it is, right, a profession, and we have unlimited profits, right? Unlimited, because there's like $4 trillion circulating in the market. However, you have to be aware that you will need not only knowledge, right? It's not only knowledge that you need and intuition, but also the ability to work under stress. So let me remove this marking so you can see what I'm trying to say here. So you also need to have the ability to work under stress, right? And the courage to take risks, because when you're trading, it's risky. But as they say, it's only risky when you don't know what you're doing. All right. So in this course, we're going to focus on the Forex basics, and we're also going to teach you advanced technical stuff, like how to look at the market, how to analyze the charts and everything. But now it's here you have to, it's not only knowledge you need, right, and intuition, but you also need the ability to work under stress. Okay, so here are some traits of a good trader. This is what makes up a good trader, right? So for you to be successful in the Forex business, you need discipline. Discipline is the first thing that you need, because without discipline, it's nothing, right? And you also need the consistency in the number of trades taken. So when you're looking at the number of trades that you take, you need to be consistent in the trades that you take, the number of trades you take per day. You need goals, right? We're going to talk about that in a moment. But for now, you need to be consistent in the number of trades that you take. So when it comes to Forex, you're your own boss. You can make your own rules. So you need to have a rule-based approach, right? So the good thing about Forex, like, you can make your own rules, right? So those rules, it now takes discipline for you to be successful, because rules are just rules, right? Unless or until you apply discipline and patience as well, right? So you need discipline and patience to be successful. So once you have discipline, you also need to be patient, patient enough to wait for a setup to play out. It doesn't mean you have to trade every day. That's what it means by patient. You can just keep some days, get some days off and stuff like that. And forward thinking is something that you need, right? The most important thing in Forex is the ability, right, to maintain good risk to reward ratios, right? This is very important. You have to respect the risk side more than the reward side, right? And the courage to take risks. We talked about this earlier, that you don't need only knowledge and intuition, but also the ability to work under stress and the courage to take risks, right? So in this case, if you see it, you have to maintain good risk to reward ratio. For example, when you say risk, it's the amount of money that you're willing to risk, the amount that you can afford to lose, right? If you read the disclaimer, you will see that, hey, you have to invest the money that you can afford to lose. It's one of the things that you need to do. So these are the required ingredients or the equipment that you need to be successful, right? Or I mean, not to be successful, but to start the like trading or learning, for example. So you need a computer. I actually strongly advise people to use, a computer when trading. A smartphone, well, not really recommended. I don't recommend anyone to use a smartphone when trading. You can actually use it to monitor your trades or to set alerts using an application called Core Levels, for example. But I don't really advise you to take trades or to analyze on your cell phone. Of course, if it's the only thing that you have, then well, you can actually do that. And you need good internet, right? So the best thing that you can do is you can take the internet cable, connect it directly to your router, and then use it that way, right? So that's the only way, because you don't need like to have these on and off kind of things on your MT4 platform. It's going to really disturb you, even disturb your trades. And you need a workspace, and goals are actually up to you. But remember, these goals, they have to be realistic. You don't have to just rush and say, hey, I'm going to make 1 million in one day. It's very impossible, right? You go on YouTube, then people tell you, hey, you can make 1,000 one day. Someone will tell you, I actually grew an account from $100 to $1,000 in 2 days. But what that person doesn't tell you is, I learned first. I had to go through the learning process first. He have made mistakes first. He have blown accounts first. And then after that, he was able to make that kind of thing. But it's about the skill. All right. It's about the skill. Okay, let's talk about the tips for a successful start. So what are the things that you need to do? First of all, you need to decide what you are in the market. What do I mean? Like, you have to decide that you're in the market for a very long haul. That is, right? You want to be a trader even 20 years from now. You need to think in terms of long term, right? Not short term. Like, I just want to trade for something else. You need to have good reasons for that. You need to also learn as much as you can, right? Okay, so you need to read, right? And listen to experts. Right now, you're listening to me, right? I'm teaching you Forex, right? But you have to keep a degree of health skepticism about everything, right? You don't just have to take every word that I say or anything like that, right? Ask questions, right? If you have any questions, you can book one-on-one meeting and ask questions. Do not accept experts at their word, right? Not everything I say is going to be reasonable. Something is just like absurd, but you just listen to it and just take it for that, right? So you have to ask questions and do not accept like an expert at their own word, right? It's one of the things that you need to do. So if you remove L from learn, you will see that it's N. So after you learn, you can then N. So learn minus L equals to N. The most important thing here is do not get greedy, right? Do not get greedy and rush to trade. It's one of the things that people have, which is why it's very important for you to have a trading plan. We're going to talk about how to create one in the near future. But for now, you need to have a trading plan, right? You don't need to be greedy, right? Take your time to learn, right? Learning Forex can actually take 3, 4, 5 months, even 7 months, even a year to learn, to fully grasp the whole concept and be consistent, right? So the markets will be here offering more good opportunities. They will not go anywhere. They've been here before you're even born, right? And they are still going to be here even when you're gone. So they will always be there offering more good opportunities in the market in the years ahead, right? Now, the other thing that you need is you need to develop a method for analyzing the markets, right? What we mean is you need to keep an open mind. If A happens, then B is likely to happen. It doesn't mean like when you come to the Forex market, you don't have to not to think about, I'm going to be looking for buys only today. So anything that you see that is telling you to sell, even if it's valid, you ignore it because you have that mindset that is like, hey, I'm looking only for sales now. Of course, there are conditions where you should be looking for a one-way ticket, but sometimes you need to look at a two-way road, right? Not only highway road. You need to look at two-way road. Keep an open mind. If A happens, then B is likely to happen. If C happens, then I'm going to go for D, right? So markets have many dimensions, and so we need enough trade confluences before taking a trade. So confluence is simply means reasons for taking the trade. Like later in the near future, we're going to talk about, for example, the M pattern, and for you to see that if the M is valid, right? There are certain reasons or there are certain things that you look at called confluences. For example, TDI confluence. For example, pivot points, EMAs, those are just additional confluences that you can use to take a trade. And you need to test everything on historical data and then in the market using real money. So first of all, you need to start in using virtual money. You need to use virtual money first before you use the real money, right? So first of all, you are learning and you're training yourself in like using virtual money. You can actually use a lot of backtesting softwares out there so you can learn faster. And you need to also be doing chart markups every day. You practice every day. If you can go through these videos over and over and over and over again, that's okay. And markets keep changing, right? Remember, we said markets are random. Now, markets keep changing. So we need to fully understand variations on the theme because it's not going to be easy every time. The aim is not going to be the clear aim that you always look for every time. It's going to be a different kind of aim that is going to be difficult for you to see. All right. So you have to develop a money management plan. This is the most important thing that you need in Forex. Money management. Now we're going to talk about money. Like I'm going to give you two types of money management pretty soon, of risk management pretty soon. You're going to see that we have psychological management and risk management. So that in money management, it's two different things. Because once you see money, things change. So your first goal, right, must be a long-term survival. Because for you to survive in the market, you need to control your risk. You need to have a good money management plan. Your second goal is steady growth of capital. You're not trying to rush things here saying, okay, for example, if you make 10% per month, think about it. Let's put it, for example, right? We'll still talk about risk management pretty soon, but let me just show you something here, right? So let's say you have an account of $1,000. I'll use something that anyone can just put in an account, right? So you have an account of $1,000 and you say you're making 10% per month. It's actually realistic and it's reasonable. So making 10% per month, you'll be risking 2%, right? So in this case, you're saying you'll be making 10% per month and you're risking 2%. And if you think about it, this is like 1:5 risk to reward ratio for the whole month. Right. So per day, you're risking 2% and you're making 10% per month. So you need to like think about how you're going to do it. So in about 12 months, you would have doubled your account. In 2 years, you would have tripled your account. In 3 years, your account is like quadruple. And in 5 years' time, the account is like times 5. You've grown your account from 1,000 to actually like 5K in 5 years, which is reasonable. And 10 years, 10K. So you'll be making 10% per year. So every time you get to 2,000, it increases to like $200 per day, per month, sorry, right? Initially from 1,000, you're making just 10% per month, which means 10% of available equity per month, right? So your third goal is to make high profits. So as your account grows, so does your profits, so does your lot size and your risk as well. So let me remove this marking so you can see what I'm trying to say here. So beware that a trader in the market, right, is the market weakest link in any trading system. You are the weakest link because you're the one who is controlling everything, not controlling everything, yes. But of course you can control the market. There are guys who control the market out there, but you're the one in control in this case. So if you don't have discipline, you're going to lose. If you have discipline, you're going to win. So it all depends on you. All right. So now here's what winners do. Winners think, feel, act differently than losers, right? So you must look within yourself, strip away your illusions and change your old ways of being and thinking and acting. So for you to succeed, you need to think like in terms of long-term goals. You need to be realistic with yourself. Get rid of fantasy thinking. Get rid of illusions. Don't ever think about, when you're trading, of course, Lamborghini will come or whatever you want to buy in the near future. That is if you succeed, right? But the thing is, you don't need to think about those things when you're trading because it's going to always force you to over risk because you're trying to rush things. And when you're investing, you need to think about, long-term survival in the Forex market. I talked about it already. And if you want to be a professional trader, you have to work on changing and developing your personality. So it's like a constant change, right? Over a period of time. It's not going to be like easy to say, okay, today I'm good. So this is what's going to happen. It's going to be like, a change that's going to happen over time. Now, in order to succeed, you need drive, you need knowledge, and discipline. You see why discipline is so important. It's not only knowledge you need. Of course, you need knowledge to analyze the markets, to see where the market is going, and you need to make the right decisions at the right time and all those kind of things. But discipline, not to follow the rules that you've made yourself. So these are the three pillars of success that you need in Forex, in the Forex market. So first of all, you need the psychology. You need to make sure that your psychology is in check. You might read other psychological books out there, some trading psychology books out there. Like, for example, Trading for a Living is my favorite, right? You can also read Trading in the Zone. It's one of the books that I'm also working on right now, that I'm starting as well. And you can also think about a lot of, like, for example, a disciplined trader. It's a good book that you can also read. The other thing that you need is technical analysis, right? So technical analysis accounts for a small percentage, let's say 20%. So when you're looking at technical analysis, you're looking at 20%. And when you're looking at money management and psychology, they account for 80%, which means you might have knowledge. You might know how to look at the market and analyze the market and know when to get in, but without psychology, without money management, you're nothing, because you will over risk and they will go against you and still go your way after after your account is blown. So there are two types of psychology of money management. We have psychological management and risk management. Psychological management, it has something to do with your mind when it comes to money. What do you think about when you see money? How do you control your psychology when it comes to money? When you see huge profits, how are you going to react? When you see less profits, when you see losses, how are you going to react? When you're in drawdown, what's your action, right? All those kind of things are the things that you look at when you're looking at psychological management. You're not only looking at money management only, but psychological management. And then risk management, it comes to risk 2% per day, which is the standard risk, right, per trade. It's that way you are going to stay in the market for a very long time. Okay, so let's talk about currency pairs here. Right, so in the trade in Forex occurs between two currencies, right? So in this case, you're actually trading one currency against the other. So one currency is being sold, one is being bought, but it's happening simultaneously, right? So I'm going to give a perfect example here. We're going to use Euro USD, right? So in this case, we're trading the Euro against the USD, right? So the buying price, which is what we call the bid, right, is, okay, let me explain this for a moment. So when you look at Euro USD, let's explain the terminology, how you actually name pairs. So I'll take USD here. So when you look at the euro is euro, it doesn't matter. So let's use the USD, for example, in this case, right? So when you look at the USD, the first two letters, they tell you the country of that currency. And the last letter, it simply tells you the currency of that country. So in this case, it's United States dollar. If you take NZD, you can pause the video and think before I say the answer. It's New Zealand dollar, right? It's NZ New Zealand dollar. You can take the Australian dollar. You can pause the video and think about the answer as well. You can see that it's Australian dollar. Or we can talk about the JPY. You can pause the video and think, right? It's the Japanese yen. So the first currency on a pair is called the best currency. And the second currency on a pair is called the quote currency. So when you're looking at the best currency, is the buying currency or the buying price. When you're looking at the quote currency, is the selling price or the ask. All right. Okay. So let's take a look at, for example, we have Euro USD is at 1.3000, and then it moves from 1.3000 to 1.3001. So in this case, we say Euro USD just moved up by 1 point or by 1 pip. Now, the difference between the two is called the spread, right? So what is a pip, right? So a pip is the unit of measurement to express the change in value. In other words, the pip is the smallest unit of a currency, right? And what is the spread? So the spread is the difference between the sell quote, which is the selling price, and the buy quote, which is the buying price in pips. So if you say 1.3001 minus 1.3000, it simply means we have 1 pip. So 1 pip is the spread in this case. So if Euro USD moves from 1.3, I have said this earlier, but I'm going to say it again. If it moves 1.300000 to 1.3001, that is 0.001 USD rise in value, which is 1 pip. So a pip is usually the last decimal place of a price quote, but we have exceptions to this, right? So most pairs go out to 4 decimal places like Euro USD, GBP USD, but there are some exceptions, like Japanese yen. It goes to 2 decimal places. So you might see something like 130.00 or 130.200. That's on pairs like GBP JPY, on pairs like USD JPY, Euro JPY. They go to 2 decimal places. All right. Okay, let's talk about the bid and the ask and the spread. So what is bid, right? Bid is what people are offering to pay for that security at that moment. So in this case, it is the buying price in simple terms. And the ask is what sellers are demanding in order to sell it, which means the ask is the selling price. Now, the bid is always lower and an ask is always higher, which means the ask is the selling price, right? It's what sellers are demanding in order to sell it, which means buyers are selling to sellers, right? And the spread between them keeps changing. So the spread varies from time to time. It can be 1.1, 1.2, 1.3, 1.4. And when it comes to news events, the spread is always higher. We're going to talk about news events in the near future. So a market order buys at the ask. Think about it. If someone wants to buy in the market, he's buying from sellers. At least it's what they tell you out there, but it's not. For now, I'm just using it for you, like in order for you to understand what I'm trying to say here. So a market order buys at ask and sell at the bid. So sometimes you might ask yourself, why is it when I buy, they place me up there and the candle is down here? It's because you're buying at an ask and they are putting you at an ask line. You won't see the ask line unless you go to settings and set that up, right? But that's how it goes. And they sell at the bid, which means they're selling it to buyers. So this is the candle. Let's take, for example, this is the buying candle. It's green. So anything that you see green on my chart is a buying candle, a bullish candlestick. So now we have the spread, right, between the two. So we have the ask line, which is always higher, and the bid line, which is always lower. And the spread is the difference between the two, which is in the middle. And let's take a look at the bearish candle that you see right here. Right, so you can see the ask line is always higher and the bid line is always lower, and the spread is the one between the two. So let's take a look at some examples here for you to understand what we're trying to say. So here you can see on the left side of your screen, we have a buying candle. On the left side of your screen, on the right side of the screen, so that we have the bearish candle. A bearish market, right? So in this case, this line here is the ask line. So when you buy on this candle, they'll put you up here, which means already you're in drawdown because of the spread. So you only go in profit when the bid line goes above your entry point. Same applies with this one here. You can see the ask line is actually the one that is always higher, right? And the bid is always lower. So when you sell, they put you at the bid. And you only go in profit when the ask line goes below your entry point. That's how it goes in the Forex market. So that's how it plays out. Okay. So let's talk about the lot size, right? So what is a lot size? A lot size is the standard transaction in the Forex market that equals 100,000 units. So this is what the lot size is what you use, right? When you're buying, you see on your chart it's written lot size, for example, you see something like this, right? So you see here, they'll write sell here, they'll write buy, and they'll put 0.01 in the middle and stuff like that, right? So in other words, it is the number of currency units you will buy or sell. Right, so we have different lot sizes we have, and position size, and the amount that you gain per pip based on the lot size, and the account size you should be using that lot size, right? So first of all, we have the standard lot size, which is 1.0. And in this case, if the market moves in your way by a pip, sometimes you're getting $10 per pip. But if it goes against you by 1 pip, it simply means you have lost $10. Or you're in drawdown, negative $10. And the account size for this is actually $10,000. All right, plus now mini lot is the 0.1, right? So when you're using 0.1 lot size as a position size, simply means you're gaining $1 per pip or lost $1 per pip, depending on where the market is going, depending on whether in profit or in drawdown. And in this case, you have to use this for a $1,000 account plus. You can't use this for an account less than $1,000, right? It's not really, I don't advise that. Now, the micro lot is 0.01. So in this case, you're gaining 10 cents per pip. Now, this is what you can use for any account that is less than 1,900 up to $5, because I used to trade small accounts. So I know that you need to use 0.01 on a $10 account, for example, or on a $20 account. And the nano, the smallest one, this one is normally used for micro accounts, right? So in this case, you're looking at accounts less than $100 or even accounts less than $5. And in this case, you're gaining 1 cent per pip. So you can use a position size calculator, right, for proper risk management. It's out there. You can go online, type in risk management calculator or position size calculator. So you can just punch in the numbers and it will tell you how much you're going to be risking, the lot size you're going to be using based on the pair that you're trading that day. So always risk 2% of your account, right, per trade. Don't ever go above that, right? In the near future, I'm going to read a book called Trading for a Living. I'm going to send it to you guys like once time comes, and we're going to read that book together. So we're going to learn a lot of things. There's what you call the 6% rule and the 2% rule. Right, so remember to apply key management rule right here. This is the formula for the risk management. So stop loss in pips times lot size must be less than 2% of your equity. That's how it goes. So for example, let's give a very good example here. Let's say your account here is actually 10,000, right? Let's say your account is 10,000 here. And we're risking 2%. So 2% of 10,000 is actually $200, right? So what it means is the lot size you're going to be using, right? For example, let's say you're using a lot size of 1, right? So in this case, if everything 1 is a lot size times, let's say your stop loss is actually let's say 15 pips, right? Which means in this case you're risking 10 by 15, which is $150. You're risking $150. So what this means is this 150 has to be less than 2% of the equity, which is $200. In this case, it's reasonable. It's actually reasonable. It's less than $2. So you have to adjust your lot size until it's actually less than 200, depending on where you're putting your lot size. Okay, so guys, this is it for this lesson. See you on the next lesson.